Good morning, students. So, the last video on cash flow statement, a complete sum. But before doing the complete sum, we will be going through a complete format. So, let's start with cash flow statement complete. Okay, a complete format starts over here. Format of cash flow statement as per AS3, cash flow statement for the year ended 31st 3 2020. It can be any year. I have taken 2020 over here. First thing, particulars, amount, three amount columns. Why? Because this inside part of every activities we will write in the first amount column. Then in the second amount column, inside those activities, whatever comes, we will be writing in the first account column. And the cash flow from operating activities, from investing activities and financing activities, we will write in the third column. And we will have our cash flow from or cash used in different activities. Let's start. So our particulars, cash flow from operating activities. Number A, net profit before tax. We have done the workings on net profit before tax. You remember we used to add many things, all the uh, things which we have transferred in order to get net profit before tax. In order to get net profit after tax, all the tax part, reserves part, all the appropriations which we have already subtracted from the profit, in order to get net profit after tax, we are adding it back and we will get net profit before tax. Then we will have adjustments for non-cash and non-operating items. First of all, let's see what are the items we add in net profit before tax. This is just a recap of whatever we have already done in various videos. So let's see. So we start with balance from surplus, that is balance in statement of profit and loss. Difference between closing balance and opening balance or surplus, that is balance in statement of profit and loss. We will get this statement of profit and loss in the balance sheet only, in under reserves and surplus. We will subtract the closing minus opening and we will get this part. Closing and opening we will subtract. Closing minus opening of the balance in surplus, balance in statement of profit and loss, and we have written it over here. And then add transfer to other reserves, add dividend payable, that is last year's proposed dividend. Remember, last year's proposed dividend, not the current year's, because whatever is current year, that is a contingent liability that will be confirmed in the coming year. So last year's we will take. Interim dividend paid during the year, we will take. Provision for tax made during the current year. Whatever tax you make the current year, that is your liability, that you need to pay. Provision for tax made during the year, so that also added. Less refund of tax, if any, credited to statement of profit and loss, that also we subtract, because if it is already credited, we need to subtract. You remember, whatever is credited to profit, we will subtract. Whatever has been debited over here means appropriated out of profit, that we are adding back, and we get net profit before tax. We can do alternatively this way also. Alternatively, increase or decrease in provision for change in short-term borrowings can be positive or negative. Okay, this is not. Alternative is the next one. Okay, no. Alternative over here means uh, if instead of balance sheet, if they give the amount of net profit in profit and loss, this is our alternative. In fact, this one, net profit before tax, when we are starting from profit and loss statement, then what will happen? That is the alternative. So net profit before tax, if we will take, that means we have already got the profit in statement of profit and loss only. They have not given us the balance sheet. That means profit after tax as per the statement of profit and loss is given. Then we will simply add provision for tax made during the year and less refund of tax credited to statement of profit and loss. Only the tax part we have not appropriated. If statement of profit and loss is given, that means already we have net profit before tax, net profit before any other appropriations. Only the tax part which was left, that we will add the refund of tax, add the provision for tax made during the year, because if we will add the provision for tax, what we will be getting? We will be getting net profit before tax. And if any refund is done, then we will subtract it in order to get effect of tax should be removed. That's why it's given net profit before tax. This is prior to the balance sheet. That means from statement of profit and loss we are preparing. When the sum has given only statement of profit and loss, then we will be doing it like this. We will only take these two adjustments, students. And if the sum has been given with a balance sheet, then we will see the difference between the closing and opening statement of profit and loss under reserves and surplus, and then whatever we have transferred, that we will add, and whatever is credited already, that is not appropriated, but we have added it up to the profit, that is refund of tax, that we will subtract. So just the opposite thing. Whatever is already added, we subtract, and whatever is already subtracted, means appropriated, that we will add. Okay. Next now. Next, uh, this one now. Adjustments for non-cash and non-operating items. Remember now, we will add all non-cash and non-operating items like depreciation, goodwill, patent and trademark amortized. That this is just like depreciation of intangible assets. Interest on borrowings and debentures, interest on bank overdraft, interest on cash credit, discount on issue of debentures, writing of underwriting commissions, share issue expenses, writing of premium on redemption of preference shares debentures, loss on sale of fixed assets, increase in provision for doubtful debts. Now, all these things already we have written in the P&L account debit, means we have written as subtracted figure, but they are non-cash. Depreciation, amortization of intangible assets, these two are non-cash. So we are adding back because this is cash flow statement. Only we will take those items which are related with cash. But you will say that interest on borrowings we are paying in cash. So why we are subtracting, why we are adding back this one? We have to already subtracted. It's correct. We have to subtract it under cash flow statement, but not under this heading. Interest on borrowings, interest on bank overdraft, all these are financial expenses. So they will be subtracted from financial activities, not from operating activities. These are not operating items. That's why we are adding back. So see, the heading is given non-operating items. Interest on borrowings and debentures, interest on bank overdraft and cash credit, discount on issue of debenture, this is also financial charges, writing of underwriting commission, share issue expenses, writing of premium on redemption of preference shares or debentures, loss on sale of fixed assets. Loss on sale of fixed assets, it's an item of investing activities. These are loss on sale of fixed asset is not an operating activity. That's why we have already subtracted in order to get our net profit. But in order to get operating profit, we need to add them back. What we are finding out? We are finding out cash flow from operating activities, and we have taken indirect method. We have started with net profit after tax. We got net profit before tax. Now we are reaching towards operating profit, and after that we will be having working capital changes, and then we will have our cash flow from operating activities. So first of all, we will be reaching towards operating activity. So whatever we have subtracted from statement of profit and loss, that we are adding back, and whatever we have increased our income, that we will subtract now, like interest income, dividend income, rental income. These are non-operating, not your sale income, not through sale. The income is not generated from operating activities. Interest income, dividend income, rental income, dividend and rental from investing activities means you have invested in shares, you have invested in debentures, you have invested in some buildings. So you are earning interest, dividend, rent. So these are already increased your net profit. So we are subtracting them in order to get our operating profit. Then if any profit on sale of fixed assets, that also has increased my net profit. So we are adding them back. Any decrease in provision for doubtful debts, that also has already we have added in our net profit decrease. So that we will add back. Similarly, increase in provision for doubtful debts, that has already reduced my profit. My Provision for doubtful debts, I have my profit has reduced. So we are adding it back. Now, student, remember one thing regarding provision for doubtful debts. Provision for doubtful debts, we can either treat over here or we can treat them in working capital changes. See, increase or decrease in provision for doubtful debts may be treated under increase or decrease in current liabilities also. In this situation, provision for doubtful debts is considered as a part of working capital changes. Changes in short term. Understood, students? Okay. Next. Now we have got what? Operating profit before working capital changes. We have written it over here. Working capital before working capital changes. Now we are using this word, this line, first column for the amount. For add decrease in current asset and add increase in current liabilities. That means add DCA and add ICL. DCA, decrease in current asset. Why do we add? I have already told you before that we add because when your current asset is reduced, excepting cash, remember it, because cash and cash equivalent we take in a separate way. That is the only we are finding it out. By preparing our cash flow statement, we are actually getting the figure which is flowing, which has either come in or which has either used. Closing cash balance minus opening cash balance. Whatever figure comes by doing this cash flow statement, we get that only. Again, I repeat. Your closing cash balance given in the balance sheet, your opening cash balance given in the balance sheet. We will subtract these two. Whatever answer comes, that is the answer of your entire cash flow statement. So, cash and cash equivalent is an item of opening and closing cash and cash equivalents. So, those two, this item which though current asset, but we do not take them in under a decrease or increase in current asset and increase in current liabilities. Excepting cash and cash equivalent, we are taking other current assets. So, when we are taking other current assets, we are getting what? We have to add the decrease in current asset. As I was giving you the example, students, that when decrease in current asset, like when we get money from the debenture holders, sorry, when we get money from the debtors, so our current asset of debtors is reduced, but our cash has increased. Now we are increasing our cash. So whenever cash is increased, we will add up. So similarly, so we say that whenever there's a decrease in current asset, like decrease in debtors, decrease in inventory, that means we have sold the goods, we have got the money. So decrease in inventory, decrease in trade receivables, decrease in accrued income. My accrued income was there, which is an asset. Decrease means I have received the money. My accrued income is received, reduced. So decrease in this, decrease in prepaid expenses. All these things are nothing but we have to add back. So we notice that these all parts, that is uh, decrease in all these current assets, have always brought cash into the business, and that's why we are adding them. Increase in prepaid expense, we have already made the expense. Now decrease is taking place. That means people are returning the money to us. Whatever expense we have done, that we are getting it back. So our cash is increasing. So that's why we are adding it. Similarly, increase in trade payables like loan. We have taken loan. We have taken our we have taken loan. Simple example, we have taken loan. So our cash is increasing. So when cash is increasing, what is happening then? Increase in current liability is taking place. And when increase in current liability means cash is also coming in. That means there is because of increase in current liability, we are adding them back. We are adding them in order to find out cash flow from operating activities. So increase in trade payables, increase in outstanding expenses, increase in advance in incomes, advance incomes. These are all added back. These are all liabilities which we are adding back. Remember that bank overdraft, cash credit increase, we are not taking it over here. We are taking them in financing activities. Now next, increase in current assets and decrease in current liabilities, we will subtract. Why increase in current asset? Just imagine one thing, increase in current asset. Means we have made more investments, current investments we have increased, suppose. So what is happening then? What is happening over here? That means our cash is going away when we are making the investments. So increase in current assets results into decrease in cash flow. So that's why we are subtracting them. That's why we are subtracting them. So this one, now we will start with this one. So we have operating profit before working capital changes we have got, and even working capital changes part also we have done. Now, after doing that, we have got cash generated from operations. That also we have written in the second column only. Cash generated from operations we have written in the second column only. After cash generated from operations, we have to subtract the income tax refund, if any, given in the sum. Refund we will subtract, and we will get cash flow from operating activities. Income tax refund we need to subtract, because income tax refund has reduced my cash from operating activities. So it is non-operating, actually. It is non-operating item. So we are subtracting it, and we get cash flow from operating activities. And we have written this in the third column. Now the second activity, that is cash flow from investing activity. As the word suggests, investing. Where do we invest and why do we invest? We invest in either fixed assets or in investments, long-term investments. We are talking only about long-term investment, students, no short-term investments. These are all long-term. Now with this investments, we get continuous profit. We get continuous inflow. When we buy machinery, we get continuous inflow. We buy a building, we pay rent, and we get continuous inflow. We buy assets, we buy investments. That means we have invested in share, debentures, whatever. Invested, that means we have bought some other company shares and debentures from share market. And we get dividend, we get interest regularly. So these are called cash flow from investing activities. So let's start with proceeds from sale of fixed assets. So we have to proceeds from sale of fixed assets. We have what? From this proceeds of sale of fixed assets, we are selling our fixed assets. So money is coming in the business. These are all direct items. You understand that. Money comes in the business, we will add. Money goes out from the business, we will subtract. Proceeds from sale of fixed assets, that is fixed assets sold, machinery sold, building sold, whatever. Even your intangible assets like goodwill sold, a part of goodwill is sold, part of trademark is sold, whatever it is. So whenever any fixed assets are sold, money comes in, so we add back. Proceeds from sale of investment, that is other than current, short-term and marketable securities, because current investment goes in short-term investment, marketable securities, this goes in cash and cash equivalent, current investment goes in other current assets and liabilities. That means working capital changes. So these three items we don't take in investing activity because they are not long-term. So any proceeds from investment, any proceeds from fixed assets, any proceeds from sale of intangible assets, both tangible and intangible, both are fixed assets. These are all increasing my cash flow, so they are added back. Similarly, interest and dividend received, rent income, purchase of fixed assets, purchase of investments, purchase of intangible assets like goodwill, etc., has reduced my cash flow. So we need to subtract them. And after subtracting and adding in the second column, the entire net value of the investing activity, that is called cash flow from investing activities, we write in the third column. Now our second activity is done. Now the last activity, financing. As the word suggests, financing, that means we are bringing money into the business, capital into the business, loan capital or own capital into the business. So whenever we issue shares, whenever we issue debentures, whenever we issue uh, preference shares or debentures or equity shares, so our cash comes into the business. Remember, student, we should take net. That means if the shares of 10 rupees are invested in 12 rupees, that means 2 rupees premium, we should take 12 rupees over here, because entire 12 rupees are coming into the business. That means security premium reserve doesn't goes in net profit before tax calculation. It comes over here. Remember it. Proceeds from debentures, that means whether in discount or in premium, the net value we will take. If in discount, suppose 2 rupees discount, then 98 rupees per debentures. 100 debentures, 9800 will be taken over here as proceeds. As money is coming in, they will be added. Receipts of security premium reserve, that's you can add over there in the shares also. Proceeds from other long-term borrowings, other long-term like bank loan you have taken. Even increase in bank overdraft, cash credit, that also will be taken over here in the financing activity, and decrease will be subtracted. Final dividend paid, if you pay the dividend, you pay the interest, so what is going out? Our cash is going out, and they are what? They are our financing activity, so we need to subtract them. Interim dividend paid, we need to subtract them. Remember, we have added them in operating because those were not operating items. So we have added back because we have already subtracted in the net profit. So we are subtracting over here this dividend paid, interest paid, interest on bank overdraft or cash credit, repayment of loans, redemption of debentures of preference shares, buying back of equity shares, payment of payment of premium on redemption. Remember it. That was also our loan, premium on redemption from Schedule 3. So we have seen. So that also needs to be subtracted. Share issue expenses, underwriting commission paid. These are all my financing expenses. So they need all subtracted. So from plus minus, we get net figure, and that net figure we have written in the third column as cash flow from or used in financing activities. So we have got cash flow from financing activity, cash flow from investing activity, and cash flow from operating activities. These three figures of the third column we will add, and we will get the last column, that is net increase or decrease in cash and bank balance. 1 plus 2 plus 3, that is the three things we will add over here, and we get that balance. After we get that balance which we have got, if we will add our opening cash and cash equivalents, cash in hand, cash at bank, short-term deposits, marketable securities, and short-term investment, if we will add with this net increase or decrease in cash and bank balances, we will get closing cash and bank balances. That is that resembles cash in hand, cash at bank, short-term deposits, marketable securities, and short-term investments. And we will see that both are matching. That means our this part, our this net increase or decrease, suppose it is 10 rupees, and opening cash and cash equivalent when we added, which is 100 rupees or 110, our closing cash and cash equivalent will be also 110. I told you at the very beginning, you can check your answer. Closing 110 minus opening 100, you will get 10, which is nothing but net increase or decrease in cash and bank balances. Hope you all have understand. Now we will be doing a sum from this one. Uh, a sum we will be doing rather. A sum we will be doing in order to understand it more properly. We have already done this all. Now we will do a sum. Okay. Acha, before we do a sum, some of the items you should remember that we do not take in cash flow statement. Like suppose we have uh, transferred the debentures into shares. So there is no cash is coming in or cash is going out. It's just from one place to the other. We are issuing bonus shares. We are issuing bonus shares. That means again reserves, from reserves we are transferring the money to the capital. So anything which is going on in between the items, we do not take. That means transaction movement of items or cash and cash equivalents are not considered as cash flow. Example, cash deposited into bank, cash withdrawn from bank. Remember it. I am depositing cash into bank. I am taking out cash from the bank. So there is no cash flow is taking place because both we have taken cash at bank and cash in hand. Both are cash and cash equivalents. So one cash changing into other cash. So we will not take that into consideration while doing cash flow statement sum. Again, transactions non involving cash flow will also not come in cash flow statement. Example, purchase of fixed asset by issuing shares, purchase of fixed assets by issuing debentures, or purchase of fixed asset on credit. No cash is going out. We will not take that in cash flow statement. Remember it, students. We will not take these items in the cash flow statement. That means in cash flow statement, transactions will only be recorded if it increases or decreases the amount of cash or cash equivalents. Remember it. It will only be recorded if it increases or decreases the amount of cash or cash equivalents. Next. So a sum now. Sum is given like this. Opening this current balances, current year's balance. 2012 we have taken current year and 2011 the previous year. Equities and liabilities, shareholders fund, share capital, reserves and surplus, non-current liabilities under that long-term borrowings is there, current liabilities under that trade payables are there, total of this liability side is there. Then assets are given, non-current assets like fixed assets are given with a note, non-current investment is given, current assets with a note, current investment is given, cash and bank balance is given, and total is given. Total of asset is equal to total of liability that we know. Now, some notes to accounts are given. First note is under reserves and surplus. Reserves and surplus. Security premium reserve is given 5,000 and surplus, that is balance in statement of PL 3 lakhs and 2 lakhs last year. You can easily understand 1 lakh has increased, and security premium reserve we will not take under cash flow statement. This is a financing activity item. We have just seen that when we issue shares in premium, we will take it over there, the money. So this item will not come in operating activity under calculation of NPBT, net profit before tax. So let's start the sum. So one more note is also given. Under long-term borrowing, the note was there. It has public deposits, 9% debentures and 15% mortgage loan. Fixed assets, there was machinery. And with machinery, there is less accumulated depreciation. We will see that also even. Means the net figure is also given as well as accumulated depreciation figure is also given. We can easily open machinery account and accumulated depreciation account, or we can alternatively take these net figures. Remember, this opening this account is quite important. Why? Whenever in this item there are generally adjustments are given, so it is better to open account and find out the missing figures. Similarly, current investments like marketable securities, short-term investment, and current investment. All these three items are given. This is a little confusing item. That's why we have taken all the items. And one more adjustment is given. Interest on loan amounted to 37,800. So interest on loan amounted to 37,800. That is also given. Interest on loan. Okay. Now, uh, we are starting our sum. First of all, we have to calculate our net profit before tax calculation. We have seen that the opening balance, that is the closing balance, that is 2012's balance, current year's balance, we have taken written first 3 lakhs. Then last year's balance of statement of profit and loss, we have written 2 lakhs. So 1 lakh is our NPBT. There is no other adjustments are given as such. So 1 lakh is our NPBT, net profit before tax. That we will be writing in our sum. See, NPBT 1 lakh. Then add non-cash and non-operating items. So what are our different non-cash and non-operating items? So non-cash and non-operating items, we have non-cash and non-operating items. So non-cash and non-operating items where we will see in the adjustment mostly. Adjustment interest on loan amounted to 37,800. This is the interest on loan. It is your financing activity. And so we have to add back interest on loan, 37,800. This is a financing activity. We will subtract interest on loan from financing activity. We have given the interest on loan. So we will add back under operating activity because we have already subtracted in order to get our net profit before tax. There is no taxation part is given in this sum, simple sum. Depreciation, we have to calculate depreciation, and for that we have to open our accumulated depreciation account. The opening balance of, that is the 2011's balance is 1 lakh, 2012's balance is 1 lakh 50,000. The balancing figure we have to take it as depreciation. So 50,000 is depreciation by depreciation. So depreciation we have written over here. Depreciation. So we add back depreciation. There is nothing to subtract as such, nothing, no amount is given. So we have operating profit before working capital changes 1,87,800. Now we will see our current assets and current liabilities. Current assets and current liabilities, when we open, it's like this. So current assets, first of all, current liabilities coming first. Trade payables 95,000 and 90,000. No note directly. That means 5,000 increase, 95 minus 90, 5,000 increase. Increase in current liability we add back. So see, we have added back increase in current liability. Add increase in current liability. Where is it? Add increase in current liabilities. Add trade payables, that is current liabilities, increase in current liabilities, 5,000 added. Then there is one more thing is there, current investment under current assets. Now see, under current assets, we have current assets, number two, current investment, 2A, current investment, but it has a note. The note, let's see the note first. Note number four, current investment over here. It is given marketable securities. Do we take marketable securities? No, we don't, because this item comes under cash and cash equivalent. Short-term investment, do we take short-term investment? No, we don't. That also comes in cost, cash and cash equivalent. Current investment, yes, this is the item of working capital changes. So we have to take over here. It's given what? 10,000. Last year, 15,000. That is increase. Always we have to subtract. Whenever asset increases, we need to subtract. Whenever liability increases, we need to add. Remember, students. So current investment 5,000 we need to subtract. So we are subtracting 5,000 current investment, increase in current investment. So we have subtracted 5,000. And when we have calculated all these things, we got in the second column 1,87,800. Acha students, I have written note over there. This is not required as such in the sum. Not required a note. This is a current note already. This is your solution. You don't require this line. One sec. So we got cash flow from operating activities 1,87,800. Cash used in financing activities, that is negative figure written in the bracket. Interest paid, cash flow from financing activities 77,200. We added this last column 187,800, 77,200 less 1,50,000, and we have got 1,15,000 as our net increase or decrease in cash and cash equivalent. It is increase over here, net increase in cash and cash equivalent. As I told you earlier that if we will add opening cash and cash equivalent over here, then we will definitely get our closing cash and cash equivalent. See, 1,10,000 plus 1,15,000, that is nothing but 2,25,000. Now, how this 1,10,000 came, that is also given, our cash and cash equivalent, that is given in the sum. Cash and cash equivalent, see over here, cash and bank balance, which is given in the sum as 1,10,000, 80,000 given over here, and some more items will be there in cash and cash equivalent. Let's see what are the next item to which it is coming. 1,10,000. See over here, current investment. It has marketable securities, short-term investment. These are my cash and cash equivalents. My opening marketable securities is 20,000 and opening short-term investment is 10,000. And that means 30,000 over here cash equivalents. And given under cash, see, cash and bank balance is 80,000. So 80 plus 30 is 1,10,000. That only we have taken over here, 1,10,000. If you notice, 1,10,000. Similarly, our closing cash and cash equivalent 2,10,000 given under balance sheet, and under working note cash and cash equivalent, that is short-term securities and marketable security, marketable investment and short-term investment and marketable securities are 5,000 and 10,000. So it's total up to 2,25,000. See, 1,15,000 plus 1,10,000, 2,25,000. Hope you all have understand this sum. Please do a complete sum. This is your homework, a complete sum. The homework is given over here. Under this, you will be doing the complete sum. This complete sum you will be doing, students. This sum, I am just scrolling it down. You can take the screenshot. You can take the screenshot of the sum. shareholders fund, share capital is given, reserve surplus, these are all have notes, long term borrowing, no notes, current liabilities, two items are given, short term provisions are given, then trade payables, other current liabilities, short term provisions, total assets, total of assets are this side. You can take the photo of this one also. Tangible assets, so many items are given, some working notes are given, little bigger sum. Cash and bank balance has a note even. So this is the entire 25 lakh 50,000, 27 lakh 25,000. That's the asset values. And your liability total was also the same. So this is your complete sum, big sum. Please do it in this sum. Some working notes is also given in this sum, like this notes to accounts 1, 2, 3, 4. All those things notes were given 1, 2. Now over here a note is there. Over here one note, short term provisions. Over here one note is given, tangible assets. Then you have cash and cash equivalents. Cash and cash equivalents, these notes are given. Additional informations: dividend paid 1 lakh, machinery purchase 2 lakh 25,000, goodwill written, that means written off of goodwill 25,000, and then you have income tax provided in the year 55,000, sold some investment as a profit 10,000 which was created to capital reserve. There was no sale of machinery, so its entire thing is depreciation. Then depreciation on land and building 20,000. Prepare cash flow statement for the year 2016. So this is your entire sum, entire chapter of cash flow to students, and hope you all have understand cash flow statement. All the 9 videos, some of the videos has ABC 3 parts. Please go through them each one and try to understand. If you have any queries, please write to me. You can call me. You can get your queries properly resolved by me. Solve the homeworks, send it to me, and I will check it. Thank you, students. Thank you very much.